Hey everyone, welcome to This Explainer. I am absolutely thrilled you're tuning in today because, well, we're going to completely change how you look at a company's balance sheet. Today, we're diving into a total comprehensive guide to understanding modern corporate value. For decades, we've basically been taught to look at a business purely through the lens of cash and profit. But in the modern world, that's really just a fraction of the story. So today, we are going to uncover the true drivers of a company's long-term success and sustainability.
So, let's just jump right into it by asking a really fundamental question, one that kind of exposes the fatal flaw of traditional accounting. Is financial profit the only measure of a company's worth? I mean, think about it. If a company makes $1 billion in profit, but they completely drain the local water supply and completely burn out their workforce to do it, is that company actually successful? Or are they just borrowing from the future to pay for today? This tension, this exact problem, is exactly what integrated reporting seeks to resolve.
Here's a quick look at our roadmap for today. 1. Beyond just the money. 2. Meet the 6 capitals. 3. The value creation engine. 4. Integrated reporting in action. And 5. Upgrading management accounting. Let's get started.
All right, Section 1, Beyond Just the Money. Traditional versus integrated reporting.
There's a pretty stark contrast to point out here. Traditional reporting is honestly a lot like looking in the rearview mirror. It focuses almost entirely on historical financial data. But the integrated reporting framework, which was developed by the IRIC, basically forces organizations to look forward and sideways. It requires companies to actually explain how their strategy, their governance, and crucially, multiple forms of capital, create or even erode value over time. It's really about telling the whole story of the business, the whole shebang, not just the financial highlights.
Moving right along to Section 2, Meet the 6 capitals, the inputs and stocks of value.
First up, we have financial capital. Now, this is the one you're probably most familiar with, right? It's the traditional pool of funds available to an organization. We're talking about equity, debt, grants, and retained earnings. Think of the share capital a company raises or the net profit it reinvests. It's essentially the financial fuel that keeps the lights on and funds all the expansions. Next up is manufactured capital. These are the physical, human-made objects that an organization relies on to actually produce its goods or services. So we're talking about buildings, infrastructure, technology hardware. A really great way to picture this is a massive factory production line, or maybe the highly specialized medical equipment inside a hospital, or even the sprawling road networks a logistics company totally depends on.
Then we've got intellectual capital. This one is the intangible powerhouse of competitive advantage. It's entirely knowledge-based. This includes things like patents, copyrights, custom software, and tacit knowledge. It's perfectly illustrated by something legendary, like Coca-Cola's secret formula, which, let's be real, is arguably worth way more than all of their physical factories combined. Or consider a pharmaceutical company's life-saving drug patents, or just the sheer brand reputation a company has meticulously built over decades. You literally can't touch it, but it's incredibly valuable.
Fourth on our list is human capital. And look, a business is nothing without its people. This capital covers the core competencies, capabilities, and experience of the workforce. But it goes a lot deeper than just a list of skills. It also includes their motivation to innovate, their overall wellness, and how well they align with the company's core values. Think of an engineering firm's highly qualified staff, or a bank's most trusted relationship managers.
Fifth is social and relationship capital. This really captures the vital trust a company builds with its external stakeholders. It's all about relationships within communities, brand trust, and how you get along with regulators. A prime example here is a mining company needing what's called a social license to operate from the local community. Or maybe a retailer building a massive, highly engaged customer loyalty program. Make no mistake, if you lose this capital, your business can quite literally be shut down.
And finally, we have natural capital. This encompasses all the environmental resources, both renewable and non-renewable, that provide goods or services to support the organization. It's the air, the water, the land, minerals, and forests. If you're a beverage company, your access to clean water is absolutely your most critical natural capital. For a timber firm, it's their managed forest reserves.
Okay, on to Section 3, the value creation engine. Let's see how these capitals interact.
So, multi-capital thinking works in 4 distinct steps. It's kind of like a giant engine. Step 1 is inputs. The organization draws the various capitals into its business model. Step 2 is business activities. Here, the organization transforms those inputs. Say, for example, using human capital to operate manufactured capital. Step 3 brings us to outputs. These are the immediate results, your products, your services, but also, importantly, your waste and byproducts. And then step 4, outcomes. This is the absolutely crucial part. What were the positive or negative effects on those initial capitals? Did you increase financial capital but severely deplete your natural capital in the process? Tracking and measuring that exact change is the beating heart of integrated reporting.
Let's move to Section 4, Integrated Reporting in Action, featuring Sasol and Unilever.
Take Sasol, a massive South African energy and chemicals company. When you read through their integrated report, we can clearly see the real-world tension between their capitals. On the financial capital side of things, they report really strong metrics, like high return on equity and solid earnings per share. But right alongside that, they report on their natural capital, detailing their high greenhouse gas emissions from their coal-to-liquids processes and their immense water consumption.
So the takeaway here is that integrated thinking requires, well, radical honesty. You actually have to confess where you're destroying value in order to create profit. Sasol explicitly shows this trade-off between its natural capital and its financial capital. It's not about hiding the bad news under the rug, it's about acknowledging value erosion in one area while reporting creation in another, and then laying out your strategic roadmap to balance it out.
Conversely, let's look at Unilever, the global consumer goods giant. Their Compass strategy shows a totally different angle. They heavily invest in social capital, like supporting over 500,000 smallholder farmers, and natural capital, through things like a net zero emissions roadmap and deforestation-free supply chains. But here is the magic of it all. They demonstrate that these non-financial investments actually yield higher financial outcomes. The brands in their portfolio with stronger sustainability credentials consistently grow faster, which drives underlying operating profit and free cash flow. In their case, doing good actually makes them more money.
Finally, Section 5, Upgrading Management Accounting. Let's link this theory to practice. Mapping these 6 capitals to your existing accounting toolkit is a total game changer. Traditional tools like budgets and NPV, they map directly to financial capital. But to measure manufactured capital, you start using life cycle costing. To measure intellectual capital, you'd look at the balanced scorecard's learning and growth perspective. Human capital connects directly to things like labor variances and HR scorecards. Social capital ties right into the customer perspective. And natural capital, that is tracked using environmental cost accounting. As you can see, the modern accountant's toolkit is expanding fast. And strategic management accounting naturally extends right into these 6 capitals. Frameworks like the balanced scorecard are practically custom-built for this multidimensional view. When you do value chain analysis now, you aren't just tracking dollar costs anymore, you are tracking the consumption of capitals at every single link in the chain. This ensures that your long-term decisions, like entering a new market or outsourcing a department, aren't based on financial costs alone, but rather a holistic view utilizing non-financial KPIs and sustainability costing.
Okay, for those of you gearing up for your WITS ACCN exams or really any strategic accounting exam, listen up. Here is your ultimate grind-to-grad tip. When you get a performance evaluation scenario, always structure your case study answers around these 6 capitals. Doing this instantly proves to the examiner that you understand multidimensional value creation. Pick out specific KPIs from the prompt and link them to a specific capital. And most importantly, emphasize the connectivity. Show them exactly how investing in human capital improves intellectual capital, which in turn drives financial capital growth. That's how you get the top marks.
As you step into your roles as future business leaders, accountants, and strategists, I want to leave you with this final thought. When you are sitting in that boardroom one day, making decisions that affect thousands of people and the environment, how will you measure the true cost of business? Financial profit is undeniably essential, but it is only one piece of a much larger puzzle. I really hope this explainer has given you the framework to step back and see the whole picture. Thanks so much for learning with me today, and keep asking the big questions.